The 4% rule is often touted as the holy grail of investing and a subject of heated debate in personal finance circles. To work out how much you need to save for retirement, simply take your planned spending, multiply by 25, and Bob's your uncle, that's your retirement number. But is it really the best way to set a retirement number or select an appropriate spending rate in retirement? Or is there a better alternative? Today we're going to dive deep into the 4% rule and find out. Hi, I'm Vince Scully, Portfolio Manager at LifeSherpa Invest, and this is Investing. Today we're talking about the so-called 4% rule and whether you should apply it in your investing journey. The rule, or probably more clearly the observation, is claimed to mean that you need to save 25 times your retirement income and you can safely retire. Although this is based on work published in 1994, it came to prominence on the internet as a result of a 2012 article and viral video of a talk given at the World Domination Summit in Portland, Oregon in 2016 by Pete Adeney, who blogs under the pseudonym Mr. Money Moustache. Now, Mr. Money Moustache, his article was titled "The Shockingly Simple Maths Behind Early Retirement," uses the rule to demonstrate, with some very suspect maths, that if you saved 64% of your pay, you could retire in just under 11 years, starting from scratch. He bases this maths on three key assumptions. You can earn 5% interest returns after inflation during your saving years. You'll live off a 4% safe withdrawal rate after retirement. And you want your stash to last forever. You'll only be touching the gains since this income may be sustaining you for 70 years or so. The third one is clearly not what the 4% rule is based on. It's based on the premise that in some 30-year periods, you fully exhaust your stash. Secondly, assumption number one, that the sequence of return risk only applies after retirement when you switch to the 4% rule. Not only that, but 5% real after taxes and fees is an aggressive target. Sure, the S&P 500 delivered positive returns in 95% of that 10-year periods before fees and taxes and has delivered an average return of 6.69% after inflation since 1957. But the period leading up to the article's publication was significantly short of this amount. The article might better be titled "The Shockingly Deceptive Maths Behind Early Retirement." But before we get into the details, we need a little bit of history. Of course, what else do you expect on this podcast? So what has become known as the 4% rule originated in the works of Bill Bengen, and originally published in October 1994 issue of the Journal of Financial Planning in an article he titled "Determining Withdrawal Rates Using Historical Data." Pretty bland title for what became a pretty landmark paper. Now, Bill was an engineer who at 43 years old made a late career change to become a financial advisor after the family soft drink business was sold. This move from engineering to financial advice is not uncommon. In fact, I too have an engineering degree, but have never practiced. But the things that make you a great engineer are the very things that stop you from being a great investor or a great financial advisor. And these are the same things that led me to abandon my career in engineering immediately after completing an expensive degree. Engineers are trained to build reliable, optimized systems based on data, logic, and predictability. And the longer you practice, the more ingrained this becomes. Now, these traits are invaluable in engineering, but they become significant liabilities in financial planning where markets are irrational, driven by human emotion, and inherently unpredictable. Now, that's not to say that engineers can't make good advisors, or even great advisors, or indeed investors. Rather, it's simply to emphasise that what might appear to be an ideal training, great analytical and numerical skills, can turn into a major disadvantage unless managed well. And these same character traits show up in the work of the other late career engineer to advisor transitions, such as Harold Evansky, whom I've spoken about previously in the episode on core and satellite investing, and I will return to in the future when I address the retirement bucket strategy. But back to Bill Bengen. In the 3 short years between qualifying as an advisor in 1990 and the publication of this article in 1994, he grappled with the question facing his retiree clients. That is, how much can I spend from my savings each year without running out before I die? And surprisingly, very little empirical work had been done in this area before. Historically, most plans had been developed based on fixed capital market return assumptions, and most online calculators, retirement calculators specifically, still work that way to this day. And this is one of the reasons why the current UK government, when in opposition, commissioned some work which suggested that they, or recommended that they be banned. We haven't seen that happen yet, but their time in office is still quite limited so far. So the alternative, the use of Monte Carlo techniques, which have been around since the work of Enrico Fermi, that's the guy who gave us nuclear power, in the 1930s. But it was only in the 1980s that the cost of computing power made it practical to use these to simulate a wide range of outcomes. This is how we develop retirement plans at Life Sherpa, given the wide range of uncertain inputs such as longevity, how long you're going to live, inflation, and market returns, to name a few. So good old Bill set out to develop a rule of thumb. And the human brain loves rules of thumb. So Bill looked at historical returns for various portfolios for investors who retired on the 1st of January each year from 1926 to 1976 to assess how much they could have withdrawn each year indexed to inflation without running out of money. He assumed that the portfolio was rebalanced back to the starting asset allocation at the start of each year, and the initial withdrawal amount was increased by inflation at the same time. This means that a retiree starting retirement with $1 million, for example, would withdraw $40,000, being 4% of $1 million, in the first year, and $40,000 plus inflation year two, and so on, regardless of what the market was doing. Critically, and this will be important when we look at this later, he assumed a zero tax rate and focused on withdrawal rates. A retiree who was required to pay tax on the withdrawal would therefore need to withdraw more than they planned to spend so they could pay any taxes that were due. Lucky for us in Australia, that's how our super funds work in retirement, for those over 60 at least. So no tax on earnings and no tax on withdrawals. A younger investor, or one drawing from a non-superannuation account, would have a different experience. And so Bill said that for retirees who commenced their drawdown after 1944, where he didn't have 50 years of history, he filled in the missing years by assuming a fixed 10.3% return on stocks, 5.3% return on bonds, and 3% inflation. Now, these are close to the long-run average returns for those classes, but don't display the sequence of return issues that Bill was trying to deal with. This means that he had 50 years of real market data only for those who retired between 1926 and 1943, a set of only 17 samples. And this is a critical limitation of the work. He concluded that a 3% withdrawal rate would have lasted all retirees 50 years using a 50% stocks, 50% bond portfolio. But at 4% withdrawal rates, a retiree starting in 1937, 1939, 1940, 1963, 1965, 1966, 1968, 69 and 73 would all fall short of 50 years, but all would have reached 30 years. He later coined the expression safe max, which is the word we use today, to describe this maximum. And probably very relevantly for us today, he found that equity allocations between 50 and 75% gave broadly the same answer, with allocations either below or above this range, reducing the possible withdrawal rates. And the main impact of increasing the stock allocation from 50 to 75% within that range was the expected size of the residual at death. And the worst year to retire in the range was 1968, when low returns and high inflation coincided. Even though the 1929 stock market crash was worse from a return perspective, the depression that followed led to deflation and strong bond returns, which cushioned the blow for someone retiring on the eve of the 1929 crash. Now, Bill's work was subsequently retested by Professors Cooley, Hubbard and Waltz at Trinity University in San Antonio, Texas, a few years later in 1998. And this work has become widely referred to as the Trinity Study. And Professors Cooley, Hubbard and Waltz came to broadly the same conclusion. They concluded that a 4% withdrawal rate provided a 95% success rate for portfolios with 100% or 50% in stocks, and 98% for a 75% equity portfolio for retirees who retired between 1926 and 1995. Generally, stock allocations less than 50% fared a bit worse. When they lifted the withdrawal rate to 5%, the success rate dropped to 85% for 100% equities, 83% for 75% equities, and 76% for 50% equities. And again, they ignored taxes and transaction costs. They used the S&P 500, the 500 largest companies in the US, to represent the equity component, and long-term high-grade corporate bonds to represent the bond component. And rather than filling in the missing years for post-1967 retirees, they limited the results to periods that ended before 1997, which provided 43 overlapping 30-year periods. Now, that's the theory. When we come back, we'll have a look at what it all means for an Australian investor.
This Is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
Now, there's been widespread criticisms of the Bengen and Trinity Study methodology and its applicability to non-US residents. Wade Pfau, probably one of the leading retirement researchers at work today, concluded back in 2010 that based on 109 years of data in 17 developed countries, that the US enjoyed particularly positive asset returns in the 20th century, and that in contrast, a Japanese retiree in 1940 would have had to limit themselves to a 0.47% withdrawal rate, while a 4% withdrawal rate had a 62% failure rate in Italy. Now, Australia falls somewhere in that range, and much of the challenge for a retiree in setting a withdrawal rate is to balance immediate spending with the possibility of leaving a future legacy. So, for example, a 60-year-old Australian couple today could buy a lifetime annuity, in effect a guaranteed income of an initial 4.75% indexed to inflation for the life of the longest surviving partner. At 67, this guaranteed income would rise to 5.38%. The trade-off to achieve this, though, is that you have no residual benefit on death after age 83. Depending on their circumstances, this could also increase their entitlement to an age pension. So what that's saying is that 4% may or may not be the right answer, and it depends on your trade-off between legacy and immediate income. It's also based on an extraordinarily small sample. The Trinity Study is based on 71 years of history, which is really only 2 independent 30-year samples. But they created 43 overlapping 30-year periods. Now, these overlapping periods will exhibit a high degree of correlation. A 30-year retirement commencing in 1966, for example, spans only 1 year less than a retirement commencing in 1965. So these results in an extraordinarily low confidence level that the result can be applied to any 30-year period. It's also based on a fairly limited range of asset allocations. The Bengen study was based on a simple US large cap, high-grade bond portfolio for a US-based investor. The Trinity study used a similar approach but modelled monthly withdrawals rather than annual in arrears as Bengen did. An Australian investor replacing part of that bond allocation with gold would have had a better experience. And the same applies in any other commodity currency country such as Canada or South Africa. It also assumes, and this is a big assumption, that the key that the worst that has happened is the worst that could happen. So the key determinant of safe max, in Bengen's words, is the experience of a 1968 retiree. So what is the probability that this represents the worst that could happen? To be fair, it was the combination of low returns and high inflation that caused this crunch and made it a worse experience than a 1929 retiree, even though the market fall was much less serious. 1910 was probably worse than 1929. So if you looked at a full Monte Carlo analysis using the full 100 years of market history now available, we can, to a large extent, eliminate that small sample impact. The next question arises, well, how long is long enough? So a 60-year-old couple today, has a 60% probability that one or other will live longer than 30 years, and a 7% chance of living longer than 40 years, and a 1% probability of surviving 45 years. A 40-year-old couple, on the other hand, has a near certainty, about 98.8% probability, that one will survive for 30 years, a 92% chance of surviving for 40 years, 59% chance of surviving for 50 years, and a 6.8% chance of surviving for 60 years. So a withdrawal rate that worked for historical 30-year periods is probably not the right answer for a couple with a 1 in 14 chance of having to make it last for 60 years. The other problem that does get a little bit of press when this topic is debated, that traditionally that indexed withdrawals may not be an appropriate basis for long-term planning. So traditionally, and certainly when I studied financial advice, spending in retirement was thought to follow what was called a smile-shaped curve, with spending starting relatively high as retirees enjoy their newfound freedom and seek to tick things off their bucket list. It then falls as their desire and ability to spend declines, only to rise again as healthcare costs climb towards the end of life. Michael Stein, author of The Prosperous Retirement, coined the terms go-go, slow-go and no-go years to characterise this trend. And that's still a good mental model for thinking about retirement spending. But in reality, spending excluding housing, and that's an important point, tends to decline in real terms, even if it might not decline in nominal terms. That means you might be spending the same or more numbers of dollars, but adjusted for inflation, it does tend to fall in real terms. David Blanchett identified a general trend among retirees to decrease their real retirement spending throughout almost all of their retirement, with annual decreases of about 1% a year that accelerate to 2% per year through the slow-go years, before turning back upwards again to align with an overall decline of about 1% annually in real terms over the entire retirement. JP Morgan, with access to masses of data on credit card spending in the US, looked at the spending habits of retirees, and their research confirms this trend. They conclude that a typical increase in spending of 1.9% annually compared to inflation of 3% in the go-go years, which they describe as 65 to 74, 0.5% in the slow-go years, between 75 and 84, while healthcare costs rise, everything else drops sharply, leading to overall declines, even in nominal terms beyond that. And these results are broadly consistent with Blanchett's number. So adopting a fixed real spending rate may therefore be overly conservative for a home-owning traditional retiree. And that leads to spending less when you need to or when you want to and the ability to do, and potentially leaving a larger legacy, or alternatively saving more during your working life. Australian rents have traditionally risen faster than inflation, so a non-homeowner that is, would expect a higher level of growth in their spending. But an early retiree at, say, age 40 may not have established consistent spending habits and may lack the capacity to trim, if necessary, especially if they've adopted an extremely frugal budget, common among early retirees, to accelerate their retirement savings. And they may also experience future life changes, marriage, divorce, remarriage, later life childbirth, which could radically alter their spending habits. So a fixed real spending target may be far too aggressive for these retirees, at least for the first 25 years of retirement. But the biggest flaw for an Australian investor, particularly, this doesn't apply to a US investor, it ignores pensions. So a constant withdrawal rate may be appropriate for a US retiree, where their social security benefit, the equivalent of our age pension, is fixed at retirement with cost of living adjustments annually. So this leaves them with a fixed gap to fill between their spending and what they receive from social security, and therefore a constant real withdrawal rate sort of makes more sense. In contrast, in Australia, though, our age pension is means tested based on income and assets, including retirement accounts like the retirement pot we're trying to size withdrawals from. And this means that the age pension puts a floor under the income and is likely to increase as your retirement savings are drawn down. So an Australian retiree is therefore likely to withdraw more early in retirement and less later when they qualify for a higher age pension as their assets fall. And modelling this is a completely different analysis than trying to assume a constant real withdrawal. Now, the impact of this will depend on the level of planned spending relative to the age pension. A 67-year-old couple planning to spend $50,000 a year will need very little savings, as the age pension will fund $46,202 of that as we go to air. But a couple looking to spend $120,000 will need significantly more and are unlikely to qualify for an age pension early in their retirement journey. In contrast, a 40-year-old early retiree has almost a full traditional retirement of 27 years to fund before they get to qualifying for an age pension, and 20 years before they get to access their super. And they'll also likely be paying tax on the earnings and on the amount they withdraw. All of this means is that a constant real withdrawal rate and the related 4% observation is not a particularly good tool for an Australian retiree deciding how much to withdraw from their retirement savings. And the only practical way to do this is to start with a spending plan and a planned retirement age and work backwards. Because the future is inherently uncertain, we don't know how long we live, what inflation will do, or what markets will deliver. So it's necessary to adopt a probability-based approach. And planning for 100% probability of success, where in this case success, like in Bengen's case, is defined as not running out of money before you die, is likely to lead to an overly conservative approach, meaning you need to save more, retire later, or spend less in retirement, and accept that you'll leave much of your wealth intact at death, much of the time. The right level of confidence, though, is personal. So, for example, a 60-year-old couple has a 20% or 1 in 5 probability that one of them will live 36 years to age 96. Couple this with a market outcome in the 70th percentile, that is, that the plan will work in all but the worst 30% of market conditions. The money will last for 36 years, and you get a 94% probability of dying before the money runs out. For many, this will be adequate given how very small changes to their spending rate early in retirement, having seen the impact of those early important market outcomes, can make a huge difference. And running out in this context means reverting to the age pension and potentially drawing down on home equity. The Government Home Equity Access Scheme, or HEAS, could mean that a home-owning couple could spend $73,803 annually after exhausting their savings. So that's less than the initial $120,000 example here, but it's hardly eating rice and beans. And it's not a million miles away from the ASFA comfortable retirement standard today. The ASFA is the Australian Super Fund, the Association of Australian Super Funds Association, who publishes a frequently updated comfortable retirement standard, which is a good benchmark, but obviously it's not what everyone wants to spend. But the contrast here with our 40-year-old early retiree couple, they would need their portfolio to last 56 years to reach a 20% survival probability. In short, the so-called 4% rule is in fact merely an observation based on a limited sample and is not particularly relevant to a market like Australia with a means-tested age pension. It's a reasonable way for an uninformed US traditional retiree to assess the amount they can spend from their savings. But it is a terrible way for a 40-year-old Australian to decide whether to toast their future earnings. Our 40-year-old earning the average full-time salary of $100,000 could expect to earn $3.6 million over the remaining 25 years of a standard working life. And that's an extraordinarily big decision to make based on a flawed observation. I'm Vince Scully, Portfolio Manager at LifeSherpa Invest. If you'd like to find a little bit more about how we apply these insights to delivering evidence-based portfolios or build retirement plans, head over to lifesherpa.com.au. That's it for this episode of This is Investing. So till next time, bye for now.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simel Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.